guys, there's one thing you have to understand. Okay, it's like this. It's like this orange. Okay, the more you squeeze it, the less resilient it has to outside forces or other forces. That means it's like a tension, right? You squeeze it for long enough, it's gonna just blah. It's just gonna like go to like all these like rotten things or whatever. It's gonna break. So it's like, it's why do I have this analogy? It's because in a market, there are also circuit breakers, right? You have the stop loss rate circuit breakers. It's like, okay, if NASDAQ or Dow Jones go down by 10%, people will come back and buy them. But usually when circuit breakers are triggered, institutional investors will come in and buy more, and then the stock will go up to another point, and then at some point they trigger a positive circuit breaker, and then they will sell, or they will sell call options to basically leverage down a little bit, to induce sort of like a fluctuation within the market. So then the cost of making a stock increase or decrease will lower. Okay, so I don't really want to get into this because this is like more advanced concept in terms of how equity market works, in a way where it's not really hedge fund manipulation or institutional manipulation. It is the way how they do their business. Okay, so instead of buying a hamburger, selling a hamburger for $10 per piece, and the government takes like 10% of that because you bloody live in California, it's like the worst state ever. They are basically selling and buying securities as a business. So, you gotta understand that. And then, so why is that important in this conversation? Is because if you look at yesterday's rebound, we call this epic rebound, or you see today's little rebound. And again, I'm transparent. I'm shorting the market, so I'm transparent of all my positions. If you watch Kevin's video, he talks about he's like, I don't know, 10% or 5% short. I'm around 40% short, and I'm around 20% leverage hedges. Okay, and then I think I hedged even less because the Russian war. So here's my take on this. So first of all, yesterday's rebound is composed of a majority of retail buy-in, and it's composed of about 1.2 billion snap calls and snap buying in by the retails. Okay. And then what is interesting about the retails is if you go look at the stimulus check, we have X amount of stimulus checks, and then I did a discounted cash flow from all of the stimulus check and all of the residual effects of quantitative easing in the previous 2 years, okay, 2021 and 2020. And then basically I narrowed it down to a certain cash value of how much in estimate retail have on hand as free cash to buy back into the market. And then everybody likes to buy the dip because everybody think, it's very cheap to buy. Also, if you really want to learn about this, there's a research paper in behavioral finance that talks about the retail psychology on how they buy back and at what point they buy back. And most of the time when the market is well and the economic is during expansion, it's great. You buy the dip and you wait a little bit and you make a profit. But right now, the situation is different. Our real inflation rate is approaching 8%. Okay, that is a huge amount. If you go look at the 1970s and if we compare oil prices to previous years, the oil increase is not going anywhere. And the Russia going to Ukraine and people claiming there's going to be war between Taiwan and China. And, I don't want to comment on any political issues. I just think Vladimir Putin is really cashing onto his promise that oil is going to be $100. And when oil is going to be at $100, and we're measuring it as a per barrel basis, right? If oil is at $100, that means pre-pandemic, oil already 2x'd. That means the cost of any goods of transportation is 2x'd, which is consistent with the shipping price increase, right? And then if that keep increasing to over $100, that means Fed have to step in and intervene. Why? Because one point in the oil price will have an exponential rate increase in any of the inflation related stuff. Your food is going to be more expensive. The supply chain is going to be stuck in its own way. Even semiconductors is going to be more and more expensive. The cost of goods would increase. That means the cost of supply would increase. And then on the contrary side, on the opposite side of this, the demand will decrease. Why? Because the cost of going out will increase, because all of your oil expenses will increase. You're less likely to drive a car, or you will drive less. Unless you have to commute every single day to work, then you're helping push the oil hike. So when oil reaches $100, that means the Fed have no choice, either double down on tapering, or they have to stop tapering, or basically end tapering in an earlier date and then just start rate hiking. Because if they don't start rate hiking, that means our nation, or America in general, is going to go into an economic recession. Not only economic recession, but economic negative growth. Okay, growth is already slowing with Netflix, Peloton, everybody. Consumer data comes out, especially after the first quarter, which is in March. We will know that our consumption habits is actually decreasing. Okay. With that said, the increase of wages is around 5.4%, right? We all know that data. But inflation is reaching 8%. That means we have a 2.6% negative growth on our wages. That means our money that we got from our paycheck from yesterday or last week or last month is decreasing at about a 2.6% a compounding rate. Which means by the end of this year, if inflation doesn't go anywhere, Fed has to match that negative growth with positive growth by increasing the rate to about 0.5% or even 0.75%. They have to speed up the process. Therefore, the market is not good. The economy is bad. Okay, it's not yet at the point where you can safely and comfortably buy the dip. I mean, if you look at Warren Buffett's holding, it doesn't change. It doesn't change at all, right? Still 60% cash. Did he buy back in? No, it's such a premature decision. But again, I am more on the short side. I don't believe that the valuation we have right now is justifiable because it's way too overvalued in its own way. Like, are we pricing in all of the consumer expectations for next year? Are we pricing in all of the fact that Americans can no longer afford a $1,000 emergency fund? The fact that the cash situation in America is actually decreasing. And then guess what? A lot of people refinance their mortgages and take out more mortgages during 2020 and 2021 because of the low rate. But the fact that the labor market is gonna switch, like the supply and demand of labor market is gonna switch. Why? During the economic recession, the labor influx is gonna outflow the labor outflux. That means there are more people willing to take on work rather than people who are quitting their jobs. Why? Because during economic recession, all of the unemployment benefits plus the tapering effect will weigh huge on consumer spending habits. Therefore, a lot of single parents families are gonna want to work more jobs. People who previously spent a lot of money on certain non-necessity groups is gonna switch their daily spending into more necessities instead of buying more useless stuff like toys or cars or whatever that you buy, or Louis Vuitton bags, whatever you're into, right? Or condoms, for example. And another thing is the crime rate is increasing, okay? The reason why you don't see that data is because district attorneys are showing that data from outside views. That means a lot of people, let's just say if you get $1,000 worth of goods stolen in your home, they don't prosecute it at all. Why? Because government do not want to see crime rate increase. Because when crime rate increase, that means the panic rate in the entire market is going to increase, and then you will see very interesting VIX effects. Okay. Anyway, this is it for this video. This is just a rundown of what I think the economy is going to go, and I'm obviously on a more bearish side because I don't believe in the variation right now. I don't believe that there are enough cash in the market to sustain the market. And I do believe that we're actually on the camel's last straw here because the Fed has already exhausted everything they can do to bail the market. There's no way they can decrease the interest rate. The only way where the interest rate is going to go is hike. When interest rate hike, the bond yield is going to hike. When bond yield is going to hike, we will see the new cycle of inverse of where bond yield goes up and the stock will go down. Therefore, the equity value is just highly overvalued right now. Okay, that's my opinion. And again, I might blow my position because I'm shorting the market, but at the same time, it's just a reality check. It's literally a reality check. How many of you beforehand you can afford 2 hamburgers at a meal, and then now you're saying, oh my God, with the increasing tax rate, with everything, it may be a bad idea to buy 2 hamburgers instead of 1, right? And look at your consumer habits. You're more likely to buy more at one trip at the grocery market than actually go in more frequently because of COVID. And the COVID is not really going anywhere at all. It's not going anywhere at all. Fauci is saying it's going to peak in February. No, because a lot of schools are running out of floating cash. What they do is they want students to go back to school. So if they want students to go back to school, they're more likely to get more positive COVID results. And if you go look at all of these USC, all of the schools who are or like other schools who are inducing, who are trying to get students back on campus, the positive testing ratio of that is hiking. And the reason why in a past a week the case reporting rate is decreasing is because we simply run out of testing kits, guys. All right, see you guys on the upside. Hope you like those kind of videos. Smash the like button and subscribe. Again, we're very honest about our positions. And for those of you who just want me to post another MMAT video, you know what? I will probably do it by this afternoon. And the masterclass, I still need to make a thumbnail. I have no idea what I'm supposed to put on a thumbnail because I've been watching a lot of YouTube videos on how to make thumbnail more appealing. And again, early access for Patreon. Patreon members can already access the masterclass, the first class, and it's really, really positive. Reviews from them. They're saying it's really, really helpful. I'm trying to explain very complex financial issues with very simple mindset and very simple words. And so, check it out when it's out. See you guys on the upside.